Okay, so for this breakdown, I'm going to be on the Aussie stock Rio, and I'll just show you quickly. We are using a wave trend oscillator and an 8 EMA, and basically what we're trying to do is I've got a higher time frame candle here. Our higher time frame candle is going to be the yearly candle, the 12-month candle, and on a lower time frame we're going to be using the overbought and the oversold level on a wave trend oscillator to basically catch the wick on the higher time frame candle, like we do with other strategies, except this is for portfolio management and investing. So I'll just show you an example of that with the blue waves. So basically, when the blue waves are going under the -60 line or above the +60 line, we say it's overbought or oversold. So those are just your extreme points, and that with a high probability, it corresponds to the upper wick and the lower wick on the higher time frame candle. When this is a lower time frame, we're going to be using the 2-day time frame for the overbought and the oversold levels paired up with the 12-month time frame, the 1-year candle. And this is just an example of the 8 EMA. So all we're saying is, and I'll break it down with Rio just to give you that example, if the yearly candle is trending above the 8 EMA, we're looking for longs. If it's under the 8 EMA, you're looking for shorts. With equities, I'm long only just because of the rules about naked short selling. I don't know if that's different everywhere else in the world, but I'm long only on equities. And anyhow, with this strategy, even if you are above or below the 8 EMA, in terms of the directional bias, the overbought and the oversold levels help you to catch just the wicks of the candles anyhow. So you're cutting out the noise of the body of the candle, and what it allows you to do is really maximize your return in terms of the investment, because you're only catching the extreme points for that year. So that's how it looks, it's oversimplification. And now I'm going to show you breaking down this year's candle on Rio. So we're going to go to the 12-month time frame, and I'm just going to stretch it out so you can see exactly what we're looking at. So this pink line is the 8 EMA. So anyway, like I said, I'm long only on equities, but besides the point, I'm going to mark up the open for this year. So that is the yearly open, and what we're trying to do is we want to catch the bottom wick of this candle at some point in the year and then ride it up, and whatever the percentage return is for that, that's your portfolio management done for the year, right? So I'll show you that. So the white line is the open for the year. So now I've dropped down to the 2-day time frame, and I'm going to just mark the open across with a white bar. So that's the price level for the open for the year. And basically on the 2-day time frame, when the blue wave is hitting -60, so it's oversold, that's when you're looking for your long positions. You're starting to think about longing the yearly candle, right? So first step is we are under the yearly open. The blue wave hits -60, which is oversold. We call it anchored sometimes. And then the last step that I would look for is that a bullish candle is closing on the 8 EMA. So that's confirmation that it's in, the bottom wick is in, unless it creates a divergence, which we can talk about. That's just a nuanced approach to it. I can show you in the former year how that happened. But just for now, those are your 3 steps. And once that bottom is in, that is when you're going to be entering the long position. And this is our exit right now, and I'll show you what the condition is for that. So on the 2-day time frame, that was it. You waited a whole year, and it's the only time that it hit was just then in August, and you entered on the close at the end of August. You've held it for 88 days, made 15%. You're done for the year for your portfolio management. That's it, right? And I will show you that, and it's going to mark it with a box to show you the exit would be on a weekly time frame, weekly hitting +60, right? Or closing above +60. That's why I said to you we're exiting now. We're exiting now on that positional hold. So that's it. You're done for the year if you were doing that. And what I want to do is mark up this area where the 2-day wave has actually hit -60, just to show you on the yearly time frame what that looks like. I'm also going to mark up the +60 to show you the upper wick, because when the year opened, we've hit the +60 once and now twice. It seems to be the same level. kind of making like a double top. That would be the upper wick for the year, is the overbought level on the 2-day time frame, just there and there, same price. And then this is basically the body of your yearly candle. So let's go back to the 12-month time frame and I'll show you that this is catching the wicks on the yearly candle. Okay, so I've had to zoom in just a little bit to show it to you, but there's our stretched out bars, and you can see more or less that we are catching the bottom wick, and if you wanted to short equities, if that's something you're interested in, catching the top wick. But it's giving you an opportunity to maximize your returns by just focusing on these extreme points. And with this approach, you probably should only be entering once or twice per year. It just depends if your entry is creating a regular divergence on the 2-day time frame, which I can show you in the previous year. It did that. It wasn't very... This year was very clean for this example on Rio, but in the previous year it was a bit messy. So I can mark up the open of the previous year, and I can show you both the long and the short for that, and how this was a regular divergence. But you can see how you're trying to enter on a wick of a candle using the overbought and oversold levels on a lower time frame, and then you're just holding it to an overbought or oversold level on a weekly time frame. So that's how you're maximizing your position with little to no effort, once or twice per year. That's the only time you're looking at it. But we'll go back and look at the previous year and see how that did. All right, so I've marked the open price for the year across here, and this was a bit of a more difficult situation. We had 1 touch point, 2 touch points just there. So you can see in this case it's actually creating the regular divergence for you to be building your position. So perhaps you would have had a bit of drawdown building this position, and it was the same with the shorts. We had a bit of a steep regular divergence if you were shorting this asset. There's a first blue candle closing above the 8 EMA after a touch point. So let's just see if you had entered there what your max drawdown would have been. 10%. That could have been quite scary. I want to see from this point up towards the weekly anchor what you would have made if this was your entry without waiting for the divergence. Let's have a look at the weekly. So that's where the weekly hit plus 60 all the way at the tippy top, which is lovely. So if you were able to stomach that 10% drop, you would have come all the way back up to a 28% after 189 days. So let's go and have a look. So that would have been the worst case. If you had waited for the divergence to be in, to be fair, you still would have probably had to hold drawdown. So you would have been entering either here or even here. So let's just see what the minimum drawdown of 6%, and then exiting at the tippy top because of the weekly hitting plus 60. So still all right if that's something you can stomach and you know that exit's coming in. 175 days, it's pushing into the next year. That's more of a messier entry because of the divergence. This is clean. It's a solo wave, very easy. But still, it is the overbought and oversold levels with or without a divergence that's creating the upper and lower wick on a higher time frame candle. So that's after the divergence is in. You're still catching the wick on the bottom of the 12-month candle, and we've been trending above the 8 EMA, even though we're looking for longs anyway only. I'll just say this, because we know what's causing the upper and lower wick on a higher time frame candle using the lower time frame overbought and oversold level with a high degree of probability, even if the candle's bearish, you can probably, still be able to long a bearish year because you're waiting specifically for this oversold level on the 2-day time frame. So let's go and have a look in 2021 what that would have looked like. Okay, so that is the open of 2021, the yearly open price. And you can see again, we have had, it's a double touch on the negative 60. That is not a proper divergence, but I have marked the candle closing above the 8 EMA as your entry point. What we'll do is we'll mark both entries. So this one coming off of anchor, and then the top of the white box is the correct one. Let's just see where the weekly exit is on this, just so we can get the worst case and the best case scenario off of this long position. Okay, so the weekly is hitting plus 60 more or less over here. It's like, let's just call it midway. I'll change the color of that. Yeah, we'll call it like where this doji is, this pink doji over there. So on a red year for Rio, and if you get a horrible entry, let's just see how bad the situation is. Drawdown of 12%, and when you exit 18% after 148 days. And best case scenario, not as much drawdown, 25%, using the overbought and oversold levels on a lower time frame married up to catch the wicks on a higher time frame candle. And there it is. When I zoom in, that is the bottom wick of this bearish yearly candle. You were still able to profit off of it because the continuation the following year was bullish. So I hope that helps, guys, with your investments. I don't use leverage for the investment side. We're just doing buy and holds, and that is it. Getting in on a 2-day oversold married up to the yearly wick, and then exiting on a weekly overbought level. Let me know if you have any questions or suggestions in the comments. Thanks, guys.